I see the number of people joining is leveling off, so I'm gonna begin with a little bit of an introduction. So thank you all for joining us today. My name is Laura Georgiou. I'm a partner with Gowling WLG out of the Montreal office. I focus on cross-border M&A tax, inbound investments into Canada, and in particular in the technology sector. I'm also co-chair of the New York State Bar Association International Cross-Border M&A and Joint Ventures Committee. Gowlings is happy to be co-sponsoring this event with Fenwick, Sanchez Devanny, and NISBA. Today, we brought together 5 tax practitioners to discuss tax trends that we are seeing in outbound US M&A into these jurisdictions. So in addition to myself from Canada, I'll let my 4 co-speakers introduce themselves. Emily, if I could start with you.
Hello, everyone. Nice to meet you virtually. My name is Émilie Renaud. I'm a tax partner at Gowling 2. I'm based in Paris, and my practice focuses on transactional tax matters mainly.
Hi, my name is Julia Ushakova-Stein. I'm a partner at Fenwick & West in the San Francisco Bay Area. And my focus, so US, I'm adding the US aspect of this panel. My focus is on cross-border M&A, international tax planning, and controversy. In addition, I also teach international tax that includes cross-border M&A at University of California, Berkeley School of Law, and at the San Jose State Master's Program.
Hello, everyone. Thank you for being here. My name is Mariana Iriarte. I'm a tax partner with the Mexican law firm Sanchez Devanny, based out on the Mexico City office. My main focus of practice is international tax on both on outbound and inbound. I also teach an international tax course in the Mexican University, Universidad Panamericana. And I am part of the international section of the New York State Bar Association and chair of the Mexican chapter of the international sections of the New York State Bar Association.
Hello, everyone. My name is Zoe Fatchen. I too am a tax partner at Gowling. I'm based in the UK, and my practice focuses on UK and cross-border M&A and investments and corporate tax structuring. And I also have a special interest in management and executive incentivization. And in addition, I'm a member of the UK-Canada Chamber of Commerce.
Thank you. A few housekeeping items before we start. I'm just going to ask everybody to make sure that they do stay on their microphones on mute for now. As a reminder, there will be a networking opportunity at the end, so we will love to hear from all of you then. We are also providing continuing legal education credits today for Canada and the US for those who are attending. Please make sure to sign in with a laptop in order to receive credit. In addition, for New York State Bar CLE credits, there will be the famous code that we will be reading later in the program, and that I understand you need to write down on the verification sheet to verify your attendance. So without further ado, let's jump into the conference. Today, we'll be covering some trends that we're seeing in M&A cross-border structures in a tech space. This includes an increased use of cash and stock consideration, the use of lockbox deals that Zoe and Emily will walk us through, some pitfalls in the efficient transaction structuring for cross-border buyers and sellers, the new European Union transaction disclosure requirements. And we're also going to be discussing some key points in the incentivization of management and the impact of the increased employee mobility on tax risks in M&A deals. And to wrap everything up, we also touch on some US post-acquisition considerations. So M&A structuring trends. When we see a US purchaser acquiring a tech company, we often see 2 things. We see the use of earnouts, and now we're also seeing a use of mixed cash and stock deals. With mixed cash and stock consideration, buyers are looking to keep the sellers interested in the ongoing management and operations of the company, and also to reduce the cash financing requirements of the deal by paying part of the acquisition price in shares of the US parent. Julia, could you tell us a little bit more about how this is accomplished from a US point of view?
Yes, thanks, Laura. You know, as you were saying, we are seeing a change more to have cash and stock mix in deals. You know, about a decade ago, we were seeing a lot of transactions, stock-based transactions from U.S. buyers. It moved on to having a cash-heavy, you know, acquisition practice, at least from the Silicon Valley perspective. Lately, we are seeing a lot more of the cash stock mix, but as you guys will all be speaking soon, from a foreign perspective, using stock can become quite complex. And if it's one jurisdiction that we're thinking about, so if we have a foreign target in a single country, let's say France, and most of the shareholders are also French shareholders, the considerations are limited. But the considerations can get quite complex if we have foreign target shareholders that are located in multiple jurisdictions. So use of cash in cross-border can still be favorable due to the complex tax considerations. On the other hand, if there is an ability to sell the shares in a period of time in which the foreign taxes have to be paid, that's also consideration that comes up when looking from a buyer and seller perspective in the cash and stock mix of a deal. Those types of considerations can be magnified in situations whenever we have combinations of more or less equals. So if we have a situation where a US company and a foreign company like to combine, you know, sometimes they're 50-50, other times 60-40 split, then one of the transactions that's quite useful is depicted here on the slide. And in the US way, we call it a double dummy structure. So here, a new company is set up, a new US holdco is set up with two foreign subsidiaries that are transitory subsidiaries. They're only in existence to be able to support either a merger of the US company or a foreign company. Another way to approach this, especially from a foreign perspective, as a number of countries have more favorable tax consequences, if instead of a merger by the foreign company, a contribution by the foreign shareholders of their shares of the foreign target to US holdco is accomplished. This structure allows to use stock of the new holdco to combine US corporation and the foreign corporation. It also has two favorable additional aspects to it. One, that is that combination is a tax-free contribution under Section 351 for US tax purposes, where the contribution of the foreign corporation shares to new holdco and whether it's a merger of the US corporation or also contribution of the US corporation stock to the new holdco in exchange for new holdco shares is altogether treated as a tax-free contribution to the new holdco under Section 351. One of the other favorable aspects of this transaction, as you'll see in the structure, is the mention of cash. And this structure allows for cash to be used in a deal if certain shareholders, especially foreign shareholders, prefer to be cashed out rather than continuing on in the ownership of the business. And there aren't any minimum requirements into how much cash can be used with this type of transaction, really making it quite flexible for a foreign acquisition. And it also makes it flexible depending on jurisdictions. If there are certain jurisdictions that do not allow for the stock contribution in a tax-free manner by the foreign shareholders, those shareholders could have the option to be cashed out instead, while the foreign jurisdiction shareholders who can use a tax-free rollover option are able to do so. One other thing to mention is, and Laura mentioned this earlier, is the use of earnouts. From a US tax perspective, the earnouts will will come up whenever there's typically when there's a negotiation for the price of the company. If there's an amount that that is a delta between what the buyer is willing to pay today and the possible increase of the value of the company over time, an earnout can be used, and there's different ways to structure it. But generally, from a US tax perspective, it's a facts and circumstances test. So to the extent that the earnout is based on business aspects, so future business earnings, it tends to be taxed as an acquisition purchase price. So it is capitalized in the basis of the foreign target, as opposed to having to support the facts that any earnout is really truly compensatory. As we'll discuss later, compensation is a deductible payment from a US tax perspective. So there are additional thresholds that have to be met to be able to get the benefit of that deduction, and the facts really have to support a compensatory payment.
Thank you, Julia. And I think you make a very good point about the structuring earnouts and how important they really are, both from the payer's perspective and the purchasers. And we see that a lot in deals where it's hard to value the goodwill of the company. So the earnout does serve that role to allow for tying a portion of the purchase price to future returns from the business. In Canada, and it's not true of all jurisdictions, but in Canada, with earnouts, it is possible to treat it as a capital gain or as part of the consideration for the shares. And the treatment in Canada of capital gains is that 50% is tax-free. So that is an important characterization for a seller. If the earnout is tied to quantifiable value of goodwill at the time of the transaction, and if the earnout feature does not exceed 5 years after the transaction year. So there are limitations. Something that we have started to see becoming problematic is when the earnout or the buyer holds back a portion of the purchase price and ties that not necessarily to the performance of the company, but rather to the fact that the employee or the principal founder stays on with the business for a given period of time. In that case, even if it may be called an earnout, it doesn't meet the criteria for capital gains treatment. So that person is receiving some sort of income and that's fully taxed. And we do try to structure around that, sometimes by trying to use what's called a reverse earnout. So instead of price plus an amount, if the employee stays on, it would be full amount paid, and then deduction or reduction of the purchase price if the employee leaves before a certain date. And you can adjust that variable portion easily by paying it in the form of a note rather than in the form of actual cash or shares. And then the note, of course, could be canceled or be paid out if the condition is met. There's limitations to this, of course. The buyer has to have the seller has to have the cash to pay the tax at time of sale. And the other limitation is that it really can only be a 3-year period because due to the Canadian rules for loss carrybacks, if the seller has a gain and then later on loses that right to that money, he can only carry back that loss 3 years. So the limitation applies to the whole earnout itself. But it becomes problematic when you're trying to mix earnouts and you're trying to mix them with cash and share deals. So cash and share deals obviously benefits the buyer, but also the seller can get a preferential tax treatment if properly structured. So for a seller, the cash part is important because in Canada we have a capital gains exemption on certain sales of what we call Canadian controlled private corporation shares. So you would see that very often being the case in the tech company space. And so each seller would get $900,000 tax-free. Sometimes they multiply that by using trusts to hold the shares, and beneficiaries being different members of their family. So you could have 5 different capital gains exemptions on that cash portion. So that would be important. And then the shares themselves that are being received as consideration can also be receiving tax deferred treatment similar to what you have on 351 exchange in the US. But the condition in Canada is that the shares you're getting back on the sale have to be shares of a taxable Canadian corporation. And I'm going to address that issue and the way around that issue in the next slide, because obviously if you have a US seller, it's not a given that you would have shares of a taxable Canadian corporation to give back on that purchase. So what happens is that when you do have an earnout and this cash and share sort of deal, or you have a full share consideration on the purchase, it's sometimes hard to fit into the earnout provision. So there's cases where we've seen the tax authorities say, well, if you've paid shares for the deal, and then there's an earnout with additional shares, those additional shares are full income. They're not additional purchase price that you can take a capital gain on. Or if you have, let's say you do a rollover and you get back shares on the purchase, but then there's a cash earnout down the road, that there's a potential argument to say that maybe that cash portion could be taxed right away to the seller. So that would obviously not be a desirable outcome to him. And we'd have to look at whether we could do a reverse earnout around that, but it does get quite complex. So really important questions that can really affect the transaction when you're looking at these kinds of features together. So I'm gonna turn it now to this second point, which is what do we do if we want to do a rollover but give back US shares? So there is a way around that, which is an exchangeable share structure. And if you have a large enough transaction and a long enough deferral period, 3 to 5 years is probably a good timing. It can be beneficial for the sellers and for the buyers to go through what I'm going to say hassle of putting this in place, because what you're really doing here is having the acquisition company, the US acquirer, create 2 Canadian subsidiaries as part of the structure. And they will play the role of giving the seller an economic equivalent to shares of the US parent until such time as there's a third-party sale and there can be cash realized to pay the tax. And so very briefly, we just put it here for reference, but very briefly, you would have a acquisition company that would basically buy the target company. This is a Canadian company, acquisition company, buy the target, give back the exchangeable shares. Exchangeable shares have economic rights that mirror the rights of the US parent, including rights to receive dividends when dividends are paid on the shares of the US parent. There's a lot of technicalities there. Sometimes the dividends are not paid, they're declared but not paid, and they're added to the value of the shares in order to get a better tax treatment for the Canadian. But ultimately, the goal is that upon a third-party sale of the US parent, the Canadian holder of the acquisition company would be able to exchange its shares for US shares and participate as part of that transaction. And everything else that's there is really to allow to work around Canadian rules. And as I mentioned, there is a lot of documentation behind this, including support and exchange agreement between the US parent and the 2 Canadian subsidiaries and the shareholders. So quite a lot of work to get to this capital gains, rollover treatment and capital gains treatment at the end of the transaction, which is not always the case in all jurisdictions. Emily, if I understood correctly, in France, you do not have this limitation when you do a rollover. The company issuing the shares doesn't have to be a French company. Maybe you could walk us through how things work in France.
Yeah, first of all, I have to say that the taxation of capital gains for French residents is not so bad in France, because French resident company can benefit from a participation exemption, allowing them to benefit from a 3% effective tax rate on their capital gains. The only condition is that they have to own a stake of at least 5% in the company, the shares of which are sold. and they shall have owned the shares for at least 2 years at the time of the sale. French individuals benefit from a maximum 30% tax rate, and lower rates can be available if the shares are owned in a tax saving plan. They can benefit, French individual, from a rollover taxation, but only if they contribute their shares to the capital of French or foreign company and receive shares in consideration for this contribution. And the second condition is that the beneficiary shall be subject to corporate income tax in its state of residence. So the rollover is available for French resident individuals. There's no condition about the nationality of the beneficiary, to the extent it is located in a treaty-protected jurisdiction. For companies, as I said, in most cases, the sellers can benefit from the participation exemption, so that they do not ask for a rollover. The rollover for companies is possible, but there are additional conditions. The first condition is that the stake to be contributed shall represent a controlling stake in the target company, or the purchaser shall already own more than 50% of the target company at the time of the contribution. And there are anti-abuse provisions pursuant to which the capital gains, the taxation of which has been deferred, shall be possible in the US, for example, if you contribute the shares to a US company. So, and you have to disclose, the main condition is that you have to disclose the whole transaction to the French tax authorities if you want to do a contribution to a US company or any foreign entity. So in most cases, we do not ask for the rollover for this last reason. And in the better cases, the French companies can benefit from the participation exemption.
Thank you. That's very interesting. And I think it gets even more interesting when we layer on other jurisdictions. So if Zoe, if you could just give us a quick rundown on how things work in the UK.
Yes, certainly. So in the UK, things in some ways work very similar to Canada. It is possible, so the cash element, of course, will always be subject to immediate taxation. And while rollover provisions may be available, there is quite a valuable tax relief available to individual sellers in relation to the first £1 million sterling of the gain which they realise, which reduces their effective tax rate to 10%. So it's always worth, whenever we can, taking advantage of that. Until recently, they had 10 million in that exemption, but unfortunately that has been tightened up in the last year or two. So to the extent that we have per capita gains well in excess of £1 million, which of course for most of our deals these days we do, the rollover capability is very useful. The UK is very flexible in that regard, so it's not necessary to roll over into a UK resident acquiring entity. And so we very often see rollovers in exchange for shares or membership interest in US entities, and that can either be the US corporation or, if we're careful about it, also an LLC. So we've seen members' interest in LLCs being successfully the subject of rollovers too. Earnouts, again, are popular in the UK, and just as in Canada, we have to be careful to structure those so that they are not taxed as the receipt of an employment-related bonus if they're being paid to someone who works in the business. And we're very familiar with doing that. Key to that can be making sure that the individual isn't required to stay in the business for too long. So 2 or 3 years are generally accepted as being long enough to protect the value of the business. Any longer than that, and the earnout starts to look, as far as the UK tax authorities are concerned, like remuneration for their ongoing employment. So we have to be careful about that. And then again, in connection with the rollover, it's very important to make sure that the acquiring entity is going to receive a controlling interest in the target. So that doesn't work if it's only going to be a minority acquisition or if you're going into a 50-50 joint venture. There are some conditions that must be satisfied, and there's a procedure for applying to the UK Tax Authority for advance clearance for assurance that the rollover will be successful and that capital gains tax or corporation tax on capital gains will not be charged in relation to the rolled over element. And typically it takes about 30 days to receive that confirmation after the application. So that's something that we always have to take into account when we're working out the timeline for our transactions.
Those are super important points, and they are different from one jurisdiction to the other, which is quite interesting. And Mariana, if I can turn it to you to talk about Mexico.
Sure, Laura, thank you very much. And in fact, yes, we find different perspectives in different jurisdictions. From a Mexico standpoint, I have to say that earnouts are also problematic in practice. And regarding the mixed cash and stock deals, in reality, from a Mexico standpoint, they do not pose any tax advantage because we don't have this rollover situation that you have described previously. Now, regarding earnouts, those could be seen as separate income for the seller or as part of the price of a transaction. If we see them as a separate income for the seller, they will be fully taxed for the Mexican corporate or individual seller. And if we have a non-Mexican resident seller receiving this amount, we will also have some confusion in connection with the characterization of such income. And this is because we would need to analyze whether such income could be deemed sourced in Mexico based on our Mexican sourcing rules. Now, if we see that as part of the price agreed in the transaction, the problem that we see in practice is that there are no specific rules in Mexican tax law that would allow to make the adjustment to the price once the transaction is closed. So this poses a problem in practice when the seller is a Mexican individual. And why is that? Because there could be some complexities inherent to the compliance with the formalities that the individual has to comply with in a regular transaction. Because once the price is adjusted, we would have to see if how could the individual comply with the additional formalities, because as I said, there are no rules in connection with this. So this remains as an unsolved issue in practice. Now, from the perspective of mixed cash and stock deals, as I already mentioned, the truth is that there is absolutely no incentive from a Mexico perspective for a difference in structuring a transaction in that way. So if we see a combination in price in this regard, in reality, this is going to be fully taxed as a full consideration for the seller. And this is because, as I said, there is no incentive in connection with, for instance, being able to apply for a rollover treatment from a Mexico perspective. The treatment for a rollover is very, very limited and only in connection with reorganizations of groups from a local and from an international perspective. However, I thought interesting, and this is what you're seeing right now in the slide, to highlight a recent transaction that we saw on the private equity space, where we advised a private equity fund in the US on the tech space that acquired a group of companies that have presence in 2 Latin American jurisdictions aside from Mexico. Now, if we go to the next slide, we will see that basically what happened in this transaction is that Mexican target shares were sold by the US corporation to the vehicle that we're showing on the slide. And what happened afterwards is that the individual shareholders that hold the US corporation and the US corporation itself, ultimately, at the end of the deal, they received some participation in the private equity fund. Now, what happened and why was this stock consideration not taxed in Mexico? Well, what happened is that the Mexican target was transferred by the US corporation, and it was transferred at a very low market value. And the reason for that is that, in fact, The Mexican target company in itself had no value. There were some hidden assets, and there were arguments to be able to say that the Mexican target had not a real value. So we transferred the shares at a low market value. The transaction that was taxed from the perspective of the Mexican sourcing rules was the transfer of the Mexican shares by the US corporation. And thereafter, the stock consideration, as I said, was received at the level of the Latin American shareholders of the US corporation, and this was not regarded as part of the purchase price. Now, since the shareholders were non-Mexican residents, of course, the additional receipt of this income, of this stock, was also not taxable in Mexico. And the reason is that this is, of course, not caught by our sourcing rules. The case would have been different, obviously, if the shareholders had been Mexicans, because then they would have to consider fully taxable income in connection with the receipt of the participation in the private equity fund. And the reason for that is that individuals and corporations are taxed on all their income. That case was different for the jurisdiction in which, in particular, these shareholders were residents, which is I'm highlighting Latin A jurisdiction. And this is because, of course, in that jurisdiction, they needed to consider this as a taxable income from their perspective. So with that, on the other slide, I only highlight the way in which the consideration was received by the US corporation and by the two shareholders of the US corporation. So with that, Laura, I think I pass you the voice for the rest of the presentation.
Thank you, Mariana. We're switching gears a little bit here to lockbox deals, which have been quite popular in Europe, but not seen very much in North America. And we started to see some questions and some potential deals where this would be used, and we thought it'd be helpful to have a little bit of an overview. So Zoe, would you mind running us through some of the basics?
Yes, of course. So a locked box is really a set of accounts or abbreviated accounts which are used to value a company or a group of companies for the purposes of a transaction. So the parties will select a reference date, which is not the same as the previous account date and also not the same as the closing date. And that often happens where, for example, the last accounts were a long time ago, so those numbers are out of date. Or perhaps when there's likely to be a period of time between the exchange of documents and the closing of the transaction. So it's typical to pick a date which is or a half-year period, or perhaps a date which is useful for other commercial reasons which are specific to the business in question. So the accounts are drawn up as at that date. And the benefit of that is, of course, that they can be flexible. So the parties can decide between themselves what they do or don't include in those and what they use as evidence when putting them together. So they may well use the last accounts as a starting point. They might use some management accounts that have been entered into in the meantime, or some projections, or perhaps a combination of those. And they can either be on a full basis as if they really were annual accounts, or simply abridged. And then everything is valued depending on what's included in those accounts. And then, of course, because our locked box date is a date before the transaction actually happens, in the real world, there's going to be some expenditure in between that locked box date and the closing date. And we refer to that expenditure as leakage. So we work out an estimate of the amount of cash, for example, that we think is in the company or the group. And then we look at the expenses that are likely to be incurred during that time. And anything which is allowable, which is typically ordinary course of business, would be permitted leakage. So we would include in that things like the wage bill for the employees, any normal acquisitions of stock, usual overheads in relation to real estate and all the standard things. And then the buyer will make some assumptions about what is or isn't likely to happen in the business in the meantime. And if the company or the shareholders of the company or the directors do anything unusual or unexpected that will cause a reduction in the value of the target in the time between the locked box date and completion, then the purchase price will be adjusted accordingly. So I'm sure you can think of some things that might include, so selling off a valuable asset, for example, entering into depreciatory transactions with other members of the retained group, or perhaps taking out cash by way of an unusual dividend. And so anything that happens of that nature would not be allowable, and then there'd be a reconciliation later to adjust. And if we move on to the next slide. Here we are. So we depend on those locked box accounts for all sorts of things, including the warranties. So typically, most of the warranties on a normal accounts-based deal when it comes to tax would be up to the date of exchange of documents, or it might say that full and proper provision was made in the previous accounts. And instead of referring to the previous accounts, we may well refer to the locked box accounts instead. And then provisions that are made in the locked box accounts, again, will be taken into account when we're working out how much tax we expect the target is going to need to pay. And also sometimes we might have assets which are valued as at the locked box date rather than at any time. And there will be provisions in the sale and purchase agreement, the stock sale and purchase agreement, which set out what the company can and cannot do in the intervening period between the locked box date and completion. And the intention there is to reduce the risk of any of that unacceptable leakage expenditure happening. And we would expect there to be a finalization of those financials and an adjustment post-closing. But we can usually make a better estimate when we are estimating based on a date which has already happened, rather than relying on closing date accounts. So sometimes it is quicker to get to a final resolution than it would have been if we only started valuing everything and looking at everything as at the closing date. And then I'm going to pass over to Emily to explain to you how this works in France.
Yeah, thank you. Really shortly, the lockbox deals are well known in France. It clearly represents a majority of our deals. But that being said, with the COVID crisis, we tend to see more and more price adjustment provisions in the SPAs. And we tend to see also buyers who ask that only part of the purchase price payable at closing, they tend to ask that only part of the initial purchase price be paid at closing, because they don't want to have to recover the overpaid amount after closing.
So it goes around and comes around, doesn't it? Thank you, Emily. So in this section, we wanted to discuss some of the tax structures we're seeing for sellers and buyers on a cross-border perspective. Julia, from a US perspective, you're saying you were seeing the cash deals, but also deals where there's a lot of intercompany debt that's used. So that's something very interesting. But maybe I'll start with Mariana to walk us through some of the Mexican structuring perspectives.
Oh, sorry. So thank you, Lara. What I was saying is that as I discussed previously, we don't have any rollovers that are possible from a Mexican perspective. And the only thing that I would like to highlight here is that if at all there were any rollovers, we will only see them in group transactions when we have stock for stock transactions, both in the local and in the cross-border context. And we would be able to apply for tax deferral authorization before the Mexican tax authorities. These days, getting these authorizations is extremely complex because of the perspective of the Mexican tax authorities with our government. And in connection with tax treaty context, there are some specific tax treaties that Mexico has in place out of its more than 60 treaties that have treaty reorganization provisions where we would not need to request an authorization for deferral, but rather comply with treaty requirements. An example of those treaties is the one with the US, where we have seen a number of intercompany transactions where we have requested this preferential treatment for reorganization purposes. Now, if we go to the next slide, we will see what we are seeing in the context of acquisition structures, and we actually see usually acquisition structures that could be structured with an intercompany debt. Also, as Laura was mentioning, as it occurs in the US, we don't usually see transactions where there is a debt in place where it will be a third-party debt, it will be a related party debt. And we have the typical interest limitation rules that we have to take care of, or that we will find typically in other jurisdictions, like our transfer pricing principles, our thin capitalization rules, back-to-back recharacterization rules, and the recently enacted 30% EBITDA interest limitation rules. Now, this structure, of course, it works as it is, assuming that the interest will be allocated in an operating company, because in that way, the interest can be deducted against operating income. Now, what happens when the purchaser does not have a Mexican company through which the acquisition can be done, a Mexican operating company through which the acquisition can be done? That will lead us to the typical transaction, which we call the leverage buyout. So if we go to the next slide, what we see is that in this typical structure, what happens is that the foreign purchaser incorporates a Mexican SPV as its acquisition vehicle, and it will hire a debt with a related party abroad, of course, in order to get interest deductions, and it will acquire through that SPV the Mexican target shares. Then what will happen, of course, because this company only holds the Mexican shares, the interest income is allocated in a company that doesn't have any operating income. So what we need to do is that we need to sit the debt in the company that has operating income. So we have two ways of doing that through a merger. Either we could do it through an upstream merger or through a downstream merger. Now, what will happen here is actually that the Mexican tax authority, of course, doesn't like this structure, because they're seeing from their perspective that the interest is being deducted in connection with a debt that was actually used for purposes of acquiring the shares of the same company that is producing the operating income towards which the interest is being deducted. So we have seen this in practice. Some clients of ours have used this structure. We know the tax authority is actively challenging this through audits, and we have not seen yet any judicial precedent actually resolving what would happen. But we feel more comfortable from an argumentation perspective to support that interest deduction requirements are complied with better when we have an upstream merger than a downstream merger. Now, with that said, I think, Laura, you want to speak about the same structure in Canada.
Yes, this structure rings true to Canada as well. The Special Purpose Canadian Vehicles Incorporated, and it acquires the target, and then we do what we call amalgamation in Canada. Timing is very important there, because if you can get it done on the same day in the right order, you avoid having 2 year ends, so you don't grind down the carry forward for loss, non-capital losses and certain tax credits by 2 years instead of 1. So that's an important factor. Same as Mariana says, the tax authorities are cracking down on the deductibility of the interest unless you can meet certain thresholds. So we have our thin capitalization ratio, which is lower than the Mexican one. It's only 1.5 debt to equity, so 60% debt to 40% equity. And we also have the new announced 30% of EBITDA limitation. But it is still quite advantageous as a structure, because to the extent that the interest is deductible in Canada, it can be returned to the US on a tax-free basis, no withholding tax on that. And the other portion of the capital, so the 40% equity, can also be returned to the US without any dividend withholding tax. So it is still the preferred investment vehicle for a US company. Emily, if you could just address quickly the French typical acquisition structure.
In France, we generally do not use the merger option, which is named the quick merger under French tax law, because the tax authorities then deny the tax deduction of financial expenses incurred by the holding company merging the target company. But we do have a tax consolidation regime, which allows the offset of the tax losses generated by the financial expenses incurred at BIPCO level against the profits of the French target. So the only constraint is that dividends, you have to pay corporate income tax on dividend voted and paid by the French target to the French BIPCO, but taxation is really not very high. Taxation is the corporate income tax rate, so 26.5% currently, assessed on only 1% of the dividend, so clearly nothing. The risk that this structure be challenged by the French tax authorities is remote if the acquisition loan is made from a third party, typically a bank loan, and to the extent also that the French BIPCO is managed from France. We also have numerous limitations to the tax deduction of financial interest, but I don't think we need to go into details.
Thank you, and that's a very good point. The amalgamation structures or merger structures are really important in the jurisdictions like Canada and Mexico that do not have the consolidation, but where you can get consolidation, they're not as relevant. And Emily, if I can keep you on board, there's another issue that comes up now more, and it's not something that in North America we're all as aware of, which is the new European Directive Disclosure Requirements, known as DAC 6, which may be triggered, from my understanding, anytime we have a EU country entity in the structure. So maybe you could give us a quick rundown of those rules.
Sure. So much has been said about this directive, but I will try to summarize the key aspects of it. So the EU directive named DAC 6 in France was introduced in 2018 and is applicable since July 2020. It is applicable in each European member state, and it imposes taxpayers and intermediaries to disclose cross-border tax arrangements to the local tax authorities. Of course, the tax arrangements are listed by the directive. They can be interpreted differently depending on the state concerned. But if you fail to the duty to disclose or to notify, you can face penalties, which can be not very high in France. It's only 10,000 euros, but it can be very high. For example, in the Netherlands, the penalty can be as high as 870,000 euros, and in Luxembourg it can be 250,000 euros, for example. So lawyers qualify as intermediary, but due to our legal privilege, we do not have to report any tax arrangement to the tax authorities, unless, of course, the client agree that we do it. But we still have the obligation to notify the client and any intermediary involved in the arrangement if we think that the scheme falls under the directive. On the next slide, you can see the list of structures of schemes to be reported to the French tax authorities, not only the French tax authorities. As I will not go through the list, it was just to show you that the list is broad. So there are many occasions in which you will have to disclose the structure, the acquisition structure. And one important thing to note that the scheme does not need to be abusive to be reportable. So as I said, the directive applies in each European member state, but the interpretations of the hallmarks can be different. And if you look in particular to the hallmark C1, which covers situations where a payment is deductible in one state and not taxable in the state of the beneficiary, either because the beneficiary is not resident anywhere, or because the beneficiary is resident in a state where corporate income tax is 0 or close to 0, or if the beneficiary benefits from an exemption in its state of residence. The interpretation of this provision can be different, for example, in the presence of foreign partnership. Some states will take the view that because the partnership is not taxable itself, taxation is assessed at the level of the partners. Any payment made to a partnership will, by definition, fall within the scope of the taxes directive and will have to be reported. Other states, such as France, look through the partnership and do the taxation test at the level of the beneficiaries, so the partners in the partnership. And some states limit the taxation test to the controlling beneficiaries, which means the beneficiaries holding a stake of 25% or 50% of the partnership, while other states also look at minority shareholders. So as you see, the application can be really different. Another difference concern the concept of tax advantage, because when we say that corporate is close to 0, in France, it means 2% or less. In Germany, it's 4% or less, and in Luxembourg, it's 1% or less, for example. So this was my short summary about the taxes analysis. I will now hand over to Julia, who will talk about the incentives of managers in the US.
Thank you, Emily. Yes, from a perspective of the US buyer, when structuring the transaction, we talked about the cash and stock and earnout part of it. But one of the ongoing incentives is in situation when you have a lot of key employees that you are bringing on, or even just the founders of the foreign target company, is to be able to incentivize them to stay for a longer period of time. Typically, in a non-acquisition structure, and sometimes in acquisition structure, what's used is just vesting of stock. And what that really means is the stock that's being issued in the transaction is issued and treated, for at least for US tax purposes, as owned by the shareholder receiving those shares. But those shares are subject to vesting, and vesting means that they can be repurchased at a minimum price up until a certain period of time. Typically, the vesting rules have what's called a one-year cliff, so nothing vests for the first year, and then a periodic vesting over a 4-year period. And however, when those shares are being issued as part of the transaction, one of the considerations of whether it's compensation or simply deal consideration is who's receiving the shares. And if the same shares are being received, the same purchase price is being received by all stockholders, whether they are actually employees that are continuing or investors, that's an argument to say that the consideration is simply consideration for the foreign shareholder stock. In that situation, it's not compensation from a US tax perspective, and simply vested consideration. However, US buyers would benefit from a compensation deduction to be able to pay comp, rather than having a payment for stock that otherwise would be capitalized in the shares of the stock. One way to be able to achieve that is through issuance of RSUs, or it can also be achieved through issuance of non-qualified stock options. And RSUs, just to give a short overview, are restricted stock units. And restricted stock units are used to be able to promise the issuance of a share after a certain period of time in the buyer. The buyer gets the deduction whenever the shares are actually issued in the future. And from a US tax perspective, generally, the issuance of the RSUs is not a taxable transaction. For non-qualified stock options, it's a similar consideration that the deduction happens whenever those options are vested. However, there are situations where incentive stock options could be used. They're typically not used in a cross-border M&A as frequently, but incentive stock options are stock options that have to meet certain US requirements and have to be issued pursuant to special plan in the US. And generally, those are less favorable from a buyer perspective because they are not deductible whenever they are exercised as compensation that's issued in the form of RSUs or non-qualified stock options could be.
Thank you. And there's this is a field where it's a minefield when you're trying to export some of those same options or RSUs into the jurisdictions. Maybe I can start off with Zoe to talk about how all this is treated in the UK.
Yes, thank you, Laura. So in the UK, we sometimes do see UK resident individuals who are employees of a US headquartered group being issued with the same incentives as their colleagues who are based in the US. And at other times, we see that a different plan will be implemented in the UK under UK rules. And that, of course, is because a plan which has tax advantages in the UK and is structured in relation to UK law won't have the same advantages in the US and vice versa. So options over shares are very popular in the UK because there's no immediate tax charge when the option is granted. So an option is an arrangement, a contractual arrangement entered into between the company and the individual, under which either after a certain period of time or on a future sale or listing of the company, or perhaps upon the achievement of certain performance criteria, shares will be issued to the individual when they become eligible to exercise their option. So if some of those performance criteria are met over time, so they vest, but the option isn't yet exercised, there's still no tax. So there's no tax arising until that option is exercised and the shares, which were the subject of the option, are transferred into the hands of the individual. And we have to be careful because in some circumstances, that tax is assessed by the individual in their personal tax return. And in other circumstances, it's for the company to account for that tax directly to the UK revenue. So we have to be careful about that. It's also possible for tax to arise on a number of different events into the future. And so it is always advisable to enter into a protective tax election to make sure that there's no risk of income tax arising at a future time, so that any future growth is taxed as capital. Because in the UK, your capital gain is taxed at about 20%, whereas your income, particularly for one of our highest earners, is taxed at 40 or 45%. So there's a real incentive there. Okay, I've mentioned tax advantaged options briefly already. So if instead of awarding someone an option, we give them shares straight away, then in that case, the award is going to be subject to tax when the shares are beneficially owned by the participants. So as soon as they receive those shares, or as soon as they receive a beneficial interest in them. So if they're held by someone else for that individual's benefit, for example, by a trust or by a nominee, then that income tax charge may still arise. And we call that a dry tax charge if it happens at a time when the individual holds shares, but perhaps doesn't have any mechanism for selling those shares in order to pay the tax. So we have mechanisms that we include in our award documentation to make sure that funds are made available to meet that tax liability. And that could include a short-term loan being entered into between the company and the individual. It might be a provision under which arrangements are made for a proportion of those shares to be sold straight away in order to pay the tax. That works best, of course, if you have a listed company where there's always a ready market for those shares. Or sometimes there can be a bonus, but of course, bonuses themselves are not very tax efficient. Okay, let's move on to the next slide. So RSUs, thank you very much, Julia, for explaining to us what RSUs are and how they work. There isn't really an equivalent to an RSU in the UK. Again, there's no tax on the grant of an RSU, but unlike an award of options and unlike an award of shares, for an RSU, usually in the UK, the tax arises when the RSU vests. And when we think about that a little more carefully, it's clear that when an RSU vests, the individual has an unconditional right to receive those shares. So it's not subject to the future exercise of an option or anything else. And because it's unconditional, the tax arises at that point. So we have to be quite careful when we have UK participants in an RSU plan, because the plan details vary. Sometimes that can have an impact on the direct tax treatment. And it's because of those kinds of uncertainties that it's very common for groups to put in place arrangements which are equivalent economically to what their managers would have had if they were US resident, but which work more effectively and more easily with the UK tax law. And then again, we see sometimes when there is an RSU which has been granted, the individual may receive a dividend equivalent right. So they might receive a cash payment, which is equivalent to what they would have received if they had actually held the shares. Those kinds of payments in the UK are simply taxed as if they were salary or a bonus. So it's subject to full income tax and social security contribution.
Thank you so much, Zoe. I'm just going to pass it to Mariana to give us a couple of points on this from the Mexican perspective.
Sure, thank you. Thank you, Laura. After hearing Julia and Zoe's intervention, I see that from a Mexico standpoint, there are many things that are similar to the UK, actually. In Mexico, we typically see two types of equity-based employment income, which is the RSUs and the stock options. The stock options are much more frequent than the RSUs. We don't typically see RSUs, although we have seen them in the past. Now, what happens in Mexico? Similar to the UK, employees are not taxed at the time of the grant, but rather they are taxed at the time of vesting in the case of RSUs, or at the time of exercise of the option, regardless of whether of the vesting of the option in the case of the stock options. Now, also similarly to what we have heard from UK, if there are any dividends received by the employee in reference to his holding of the RSU or the stock options, because of course, the employee doesn't really own any stock yet, those dividends are taxed also as regular employment income. Now, if we go to the next slide, regarding the way in which the tax is paid, the payment mechanism really depends on who granted the award. We typically see that the one that grants the award or the stock option would be a foreign related party of the employer, because the employee will have the option or the opportunity to own a share of the group outside of Mexico. So in that case, the employee will need to pay his tax liability directly. Now, if and not so typical, if the award or the option is granted directly by the Mexican employer, then such employer is the one that will need to withhold the relevant tax as an employer. Now, what happens upon the transfer of the shares once the RSU vests or the stock option is exercised? Well, if they are private shares, they will be taxed regularly. If they are public shares, then we have an incentive of being able to apply for individuals a preferential 10% capital gains tax. So with that, I pass the voice, I think, to Emily.
Yeah, Emily, we only have a couple more seconds. If you just give us a quick rundown of
Okay.
French.
Okay, so we also have a favorable tax and social regime available to French managers, to which are granted free shares of stock option plans. Basically, in France, employment income are subject to a 60% tax rate, while capital gain are subject to a 30% tax rate. So the free share plan, for example, allows to benefit from a 38% tax rate. We also have free warrants, which can be granted to French beneficiaries if the company has been created less than 15 years ago, in which case they can also benefit from the 30% rate. Unfortunately, in most cases, US plans are not eligible, at least directly, to this favorable regime. There is one possibility for the US entity to approve a French sub-specific plan, which would then significantly differ from the US plan because it has to comply with the French commercial rules. For example, the actual shares shall be issued at the end of the vesting period. There is a vesting period of 1 year minimum. There is a holding period of 1 year minimum following the vesting period. And no free shares, for example, can be granted to a beneficiary already owning 10% or more of the issuing company. And the issuing company cannot grant free shares representing in aggregate for all beneficiaries more than 10% of its share capital. So sometimes it's possible, but in most cases we use other kind of incentives. In domestic transaction, we use a lot what we name ratchet profit shares. Profit shares are paying instruments. So the manager subscribe to the share capital in cash and receive preference shares with financial rights, which are disconnected to the percentage of the share capital they own, and which allow them to benefit from a progressive and preferential share of the sale proceeds upon exit.
Thank you so much, Emily. And if I can just quickly touch on Canada, it's really about two types of incentives that work here. The preferred is the stock option plan. If done properly, it allows the employee to have taxation only upon the exercise of the option, and also a benefit from a 50% deduction, which effectively gives them equivalent to capital gains treatment. There are a lot of rules that have to be met regarding both the strike price of the shares, the types of shares and rights of the shares being granted. And now there are special rules regarding how much can vest in a certain year. So as of July 1st, only the first $200,000 that vests in the year can benefit from the 50% deduction. So a lot of plans that may have a cliff vesting feature would not work anymore. You'd want to have gradual vesting over several years if the stock options are for a large value. The other option that works in Canada are restricted share units, but they have to be amended for Canada in particular. If the issuer has the option to settle the RSU in cash or shares, so it's option of the issuer, not of the employee, then the plan needs to vest effectively within 2 years of the year of grant in order for the employee not to have an immediate income taxation at the time of grant. So that we really work to amend either put in place a Canadian subplan or amend the Canadian award agreement to really allow the employee to get these preferential treatment in Canada. And restricted shares not done in Canada at all. There's just immediate taxation. So I'm gonna skip through this and get to the key information for all our New York State Bar participants. The key word is tax 062421. I'm just gonna leave it up there for a second. You need to put this on the affirmation form of attendance affirmation form, and it should be mailed to mcle@fenwick.com, mcle@fenwick.com. And if I could just give the last word to Julia to talk to us about some post-acquisition considerations.
Thank you, Laura. And just to quickly mention, as part of the acquisition structuring, I know earlier debt was discussed, and from a U.S. tax perspective, the acquisition structure also has to be thought of in the holistic view of the buyer, including not only where a foreign entity is going to be located, but particularly where that foreign target, whether that foreign target is going to continue to operate in its own, or whether there could be situations where all the employees of the foreign target will be transferred to an existing local entity of the foreign target. And in that situation, a foreign acquiring subsidiary may be used. Thus, intercompany debt could possibly be used as well if helpful. And on another situation, one of the things that are considered is the location of the IP post-acquisition, especially in the tech space. This tends to be one of the driving forces of which entity acquires the foreign target, whether it's a domestic subsidiary or the U.S. multinational itself, or a local subsidiary. And this is important in order to be able to understand how to bring back the IP into the US if the IP does need to be centralized in the US, both from a legal perspective and a tax perspective. A Section 338 election may be used to help with this. And a Section 338 election allows for an acquisition of the target company, a stock purchase of the target company, to be treated as an acquisition of assets, allowing for a step up in the basis of the assets. If the IP is subsequently sold by the foreign target immediately after closing back to the US, this could help with guilty implications. So an increase in the tax basis could result in zero guilty from a US perspective. In addition, one other approach that can be used is what's called a check the box election, where the foreign target is checked to be treated as a disregarded entity for US tax purposes, not foreign purposes. And that allows for the IP to be, it's liquidated at that time of the check the box election. And the IP then is owned by the US company that owns that checked foreign target, for US tax purposes. But there are certain complex considerations for foreign tax credits. If there are foreign taxes, whether from the sale of the IP or otherwise in the now branch of the US owner, that have to be considered in those post-acquisition plans.
Thank you so much, Julia. And that completes the presentation portion. Julia, Mariana, Emily, Zoe, thank you so much. Thank you all for joining. If you want to just sit tight real quick, we're going to be branching out into a couple of breakout rooms for a little bit of an informal chat and answer any questions that you might have.